Hello and welcome to Byjus Exam Prep IAS. Welcome to another session of economy this week, wherein we are taking up all the important economy related articles which have appeared in various business related newspapers from 13th to 19th of August 2022, and we are analyzing these particular articles. Let's start the discussion. The first article is regarding lending rate regimes. First and foremost, what do you mean by the term lending rate here? Imagine you go to a bank, you will apply for a loan. Either it could be a housing loan, personal loan, a vehicle loan, whatever the type of a loan is. You have applied for a loan. And whenever you apply for the loan, the bank will charge a certain rate of interest on the loan. That is how the banks generate a lot of business as well as revenues. So they will charge a rate of interest. Now this particular rate of interest is basically the lending rate. Currently, understand the logic here, currently the loans which are given, specifically the loans which are given to housing sector etc., MSMEs etc., the rate of interest that is charged by the banks is based on a concept called as external benchmarking. This idea of external benchmarking has been proposed and implemented by Reserve Bank of India, and banks are following the concept of external benchmarking. But before the introduction of external benchmarking, what were the different lending rate regimes that were present? The Reserve Bank of India back in 1994 liberalized the concept of interest rates, that is lending rates. RBI said, we will give you a formula, and based on that particular formula, you decide your lending rates. And that is the precise time period wherein the Reserve Bank of India introduced the concept of the primary lending rate, PLR. And again in 2003, the prime lending rate was replaced with benchmark prime lending rate, BPLR. And again in the year 2010, RBI replaced the BPLR with a concept called as base rate regime, BRR. And in 2016, RBI introduced the concept of MCLR, marginal cost of funds based lending rate. Now some of you might be thinking, sir, why is RBI changing these particular regimes regularly like this? What is the reason? The reason is very simple. Earlier these particular banks were given certain freedom to decide their lending rates. Now RBI felt that when I give the freedom to these particular banks to decide the lending rate, whenever I change the rate of interest, that is, understand the sequence here. Here is the Reserve Bank of India. RBI will give loans to banks, and the banks will give loans to customers or borrowers. This is how the sequence actually takes place. So RBI is of the opinion that whenever it will give loans, let's say at a higher rate of interest, the banks are very quick to transfer this particular increased lending rate to the customers. But whenever RBI reduces the rate of interest, banks are not very quick enough to transfer these particular benefits to consumers, or let's say the borrowers in the market. In simple terms, whenever the policy rates are changed by RBI, there should be change in lending rates, there should be either expansion in the credit, that is loans given by the banks, or there should be reduction in the amount of loans given by the banks. That should happen, or this kind of a movement in the lending should happen whenever RBI changes the rate of interest. This is essentially referred to as a concept of monetary policy transmission. So being concerned about monetary policy transmission, being concerned about arbitrary nature of some of the factors that are considered by the banks who are the lenders here, take into consideration various factors, Reserve Bank of India from time to time has kept on changing the lending rate regimes. So the first one was PLR, and the most recent one is the concept of external benchmarking. Now here is one question for you people. Which committee was set up by Reserve Bank of India, and this committee which gave the recommendation to external benchmarking, to introduce the external benchmarking? What is the name of the committee? If you know the answer to this particular question, write in the comments. So latest one which we have introduced is external benchmarking. Now very recently, RBI has published a paper, a survey paper has been done, and in this particular paper, it comes to a conclusion that though MCLR, marginal cost of funds based lending rate regime, which was introduced by RBI back in 2016, though the monetary policy transmission was much better in this compared to other regimes. I hope you understand this. The comparison has been made between base rate regime, BPLR as well as MCLR like this. And the conclusion is that when the MCLR was introduced, the monetary policy transmission that happened was much better compared to what was the transmission in the earlier lending rate regimes. However, this particular paper also notes that the MCLR has not been able to meet the expected results. With what expectation we introduced, we have not been able to achieve those particular objectives. These are the two very important findings which have been published in this particular paper published by RBI. Now, in terms of data, which I don't recommend you mug up, but the data simply says that with the introduction of MCLR, marginal cost of funds based lending rate regime, the transmission was much better. How much better? Imagine if RBI increases or changes the lending rate by 100 basis points. The overall, that is weighted average lending rate, the overall rate of interest that was increased by the banks was in the range of 26 to 47 basis points. Now, some of you might be hearing this particular term basis points for the first time. Simple, 100 basis points is equal to 1%. I hope you understand this. 100 basis points is equal to 1%. If I simply say 25 basis points, it is equal to 0.25%. So whenever RBI changed the lending rate by 100 basis points, the weighted average lending rate under MCLR changed by 26 to 47 basis points. This is better compared to the earlier transmission, which was in the range of 11 to 19 basis points. So this is the data that has been provided in the latest publication of RBI paper on the lending rate regimes. Now, based on this, I've given a question here. Arrange the following in chronological order of their introduction. Basically, these are nothing but the lending rate regimes that have been introduced by RBI over a period of time. One is external benchmarking. External benchmarking has been introduced very recently, the most recent one. So the end has to be with 1, or the most recent has to come at the end, that is 1. Here itself you can find out the right option for this particular question. But anyways, benchmark primary lending rate, and marginal cost of funds based lending rate. So first one was primary lending rate 3, followed by benchmark primary lending rate 2, followed by the marginal cost of funds based lending rate 4, and finally the most recent one, external benchmarking. So the right option for this particular question will be option D, 3, 2, 4 and 1. Next article, Government of India has invoked certain provisions of Essential Commodities Act. As such, this concept of Essential Commodities Act has been there in the discussion. Please be very careful. Why? Let me give a very simple example here. Couple of years ago, Government of India introduced 3 farm laws or 3 agriculture laws. One of these particular agriculture laws was basically to amend the Essential Commodities Act, which has been withdrawn by Government of India. But very recently, looking at one very important agriculture commodity whose prices have been rising, Government of India has invoked the Essential Commodities Act of 1955. Now, what is this idea of an Essential Commodities Act? The concern for the government is that in the market, whenever the prices will start rising up, whether agriculture commodity or a non-agriculture commodity, doesn't matter. Whenever the prices will start rising up, it will contribute to inflation. All of you will agree with me. Right? So whenever the prices will rise up, it will contribute to inflation. But whenever the prices will rise up, what if the cause of this particular rise is artificial scarcity in the supply? That is, the scarcity has been created. Scarcity simply means the supply is comparatively lesser than the demand. So the supply is lower than the demand, And as a result of this, the prices will start rising up. But the reason there is an imbalance between the supply and demand is that there is a reduced supply. It's not because the demand is rising up here, it's because the supply of the commodities has been withheld. Sir, what do you mean by that? Let's take a very simple example here. Imagine, here is a farmer. The farmer has cultivated certain crop. The crop will be purchased by a middleman, right, or a trader, etc. And the middleman will introduce this particular crop in the market, where all of you will purchase this particular crop. Now, what if this particular middleman, rather than supplying these particular commodities, a large part of the commodities, the middleman will store it. They'll simply store it, doesn't supply this to the market. And whenever this is an essential commodity, whenever it is a commodity which is required by all of us, for example, let's say pulses, onion, tomato, potato, etc. Whenever these are the goods which we consume on day-to-day basis, the supply is reduced. There is an imbalance created in the market. That is, there is an artificial scarcity which has been created in the market where the demand is higher compared to supply because the supply has come down. And this will create a shortage of supply, or there is a scarcity situation. It will lead to rising up of the prices in the market, which will no doubt contribute to inflation. And some of you might be thinking, sir, what is the advantage to this particular middleman? Why is the middleman doing this? Simple. Imagine I am that particular middleman. Again, I am saying imagine. I don't do this, but let's say imagine. I have purchased this particular crop or a commodity from the farmer at, let's say, 30 rupees per kg. If I supply to the market, right now I might be selling it at, let's say, 40 rupees per kg. But I want to earn more. Is it not the ultimate objective for everyone in the market? I want to earn more. So rather than supplying everything in the market, I will withhold large quantity of it. There is a scarcity. Market prices will hit, let's say, 60 rupees per kg, 70 rupees per kg. Now I will introduce these particular commodities in the market, earn huge amount of returns. Right? This is how generally you can see there's a shortage created in the market, right, which will lead to increased market prices, and there is a huge amount of earning. This is one way. Another way is, what if there's a cartelization? A cartel is formed. Cartel means group of producers. Cartel is formed. These particular cartels, right, will basically withhold the supply, withhold the production and supply. That will lead to creation of scarcity. Again, the market prices will rise up. But right now, focus on this. Right now, focus on the first situation here. Whenever these kind of situations exist, to overcome these, the government of India has introduced the concept of Essential Commodities Act of 1955. And under this Essential Commodities Act, there is no proper definition that has been provided by the government. The government simply says, anything that is listed in the schedule of the Essential Commodities Act by nature becomes an essential commodity. If you understand, if the government says this particular commodity, the marker that I am holding in my hand is an essential commodity, and they will list the marker under the act, one of the schedules of the act, then this becomes an essential commodity. So government from time to time will keep on listing these particular commodities. And the advantage here is that whenever a commodity is listed as an essential commodity under the act, the government will have search and seizure powers. The state government can go search, seize the commodities if there is any stock which has been held beyond the limits prescribed under the Essential Commodities Act. And very recently concerned about one of the types of pulses. Which type of pulses? Don't worry, right? Because the general argument is that the pulses, vegetables, etc., these keep on contributing to inflation in the market. So concerned about the market prices of the pulses, and concerned about lot of storage that has been done by the middlemen or the traders, Government of India has introduced the Essential Commodities Act provisions on the tur dal. And it says that weekly the middlemen or the traders will have to keep on reporting how much stocks they are holding of tur dal in a website or a portal, so that we can keep a track of whether there is this kind of excess storage or hoarding that has been conducted by the middleman. So this is regarding the article on Essential Commodities Act. Next article regarding Competition Commission of India, CCI, Competition Commission of India. First and foremost, Competition Commission of India is a statutory body. Remember this. It's a statutory body. That is, Government of India passed the Competition Commission Act, and as a result of this, the Competition Commission of India has been established. And whenever the Competition Commission of India gives a verdict or an order, there is an appellate body, Competition Commission Appellate Authority. I understand this? Competition Commission Appellate Authority. So this is the basic idea. Now why it is there in the newspaper? Why Competition Commission of India has been there in the discussion in the last 2 or 3 months? This is because Government of India had set up one committee which was headed by Mr. Injeti Srinivas back in 2019, gave a recommendation that we should review the framework, we should make certain changes to the Competition Commission of India Act. And that is the precise reason very recently Government of India has introduced amendments, not yet passed, has introduced the amendments to Competition Commission of India Act or Competition Commission Act of 2002. And some of the provisions are there in the newspaper. We'll have a look at it. But one provision that has been discussed in this particular article is the concept of leniency plus regime. Now, before understanding what is this leniency plus regime, let me start with a very simple example. Imagine you want to go to the office and you earn the salary in terms of lakhs of rupees. Now, what has happened? One of the kids in your home has taken the key of your car, has hidden the key somewhere in the home. Now, the kid wants to play with you and says, you try to find out. Now, you have two options available with you. One, spend hours and hours, spend a lot of time, maybe half a day or a full day to search the key and waste one of the days where you could have earned huge amount of salary by going to the office. Or another example or another option that is available to you is bribe the kid, give the chocolate, give let's say 10 rupees or 100 rupees maximum, and ask the kid to give out the location or to basically give you the location of the key where the key has been hidden. Most of us will go with the second option because obviously the concept of opportunity cost comes into picture. You would rather go to the office, right, earn huge amount of salary rather than wasting let's say 5 hours or 6 hours in search of a key. Same logic, the government has introduced the concept of Competition Commission Act. What do you mean by this? In the earlier article, we have discussed the concept called as a cartel. What is this idea of a cartel? Cartel simply is grouping of all the producers. Right, sir? Understand this. Some of you would be worried saying, sir, what are you talking of? Right? What is this cartel? What is the bribe are you talking, etc.? Let me explain it. Imagine there are 3 producers of a particular product. A, B and C, 3 producers. All of them produce and supply certain commodity in the market. Now all the 3 will decide not to sell the product at a particular price. That is one way. Or else another situation is A will acquire B and also acquire C. Right? They will simply acquire the companies. Now there is only one supplier. One supplier will decide what is the price of the product. And if the supplier A increases the prices, you don't have any option. There is no other competitor in the market. Basically, you will have to shell out more amount of money. This is the basic idea through which the market prices can be manipulated. But look at the idea of a cartelization. Cartelization means what? All the 3 have come together. They have not merged or amalgamated. All the 3 are individual companies, but they have formed a group like this. They want to basically increase the prices. They want to manipulate the prices. And because there are only 3 suppliers, if you want to purchase, no other supplier is there in the market, you will have to shell out more money. Now understand the problem here. Government of India, in order to overcome this issue of cartelization, has introduced the concept of Competition Commission Act. And it is the duty of the Competition Commission of India to investigate such cartel issues and penalize the participants in the market. But the problem here is, it is very difficult for the Competition Commission of India to find out where our cartels are taking place. If there is a cartel, how they are manipulating the prices, etc. They need to spend a lot of money. They need to spend a lot of manpower resources. Lot of costs have been incurred, etc. Now, to overcome this, what the Competition Commission of India says is, there is a lesser penalty rule. Remember this, lesser penalty rule, which is also referred to as leniency regime. Under the leniency regime, imagine all the three companies are expected or alleged to be involved in a cartel. The Competition Commission of India will tell the company, see, you give out the information regarding the cartel. Basically, you tell how the cartel was made, how you are manipulating, who else is present in the cartel, and you snitch on your, let's say, the other participants in the cartel. I will reduce the punishment on you. Whenever I will impose a punishment, I will have a lenient view over imposing the punishment. That is the concept of leniency regime, which is already there under the Competition Commission Act. But now Government of India, under the new amendment, wants to introduce leniency plus regime. What is this leniency plus regime? Under the leniency plus regime, government says, you might be involved in a cartel. Let's take the same example of company C. You're already involved in a cartel. I'm investigating against you. You want to give the information regarding other participants in this cartel. Yes, I will have a lenient view. But apart from this, you also know that there are certain other sectors where there are cartels. You know how your let's say friends in other companies, they are making a cartel. You know regarding the cartelization in other sectors also, apart from the one which you are already involved in. In such cases, give out the information from that cartel also. Give us the information from that particular cartel so that we can further reduce the punishment that we are going to impose on you. This regime is called as a leniency plus regime. So already leniency regime is present, that is a lesser penalty rule is present. Now we want to introduce a leniency plus regime. Is India the only country to have this kind of a leniency regime as such or lesser penalty regime? Absolutely no. There are many other countries such as UK, US, Singapore and Brazil which have already implemented the concept of leniency plus regime. So this is the gist of the article provided here. Now based on this, let's have a look at the question here. Consider the following statements regarding Competition Commission Act. The government, by amending the CCA for the first time, will be introducing any sort of leniency regime under the CCA. Statement is wrong. Leniency regime is already present. Will be introducing leniency plus. India will be the first country to introduce a leniency plus regime. Statement 2 is also wrong. Right option is option D, neither 1 nor 2. Let me go to the next article regarding global tax deal. Already in the earlier videos we have discussed regarding the global minimum corporate tax deal that has been there in the discussion. There are more than 130 countries or nations which have come together, which came together earlier, signed a deal under which there are two pillars, Pillar 1 and Pillar 2. Is India a party to this particular agreement? Of course, yes. India is one of the very important participants in this particular global minimum corporate tax deal, which was basically proposed by USA, but the idea of framework was given by USA, and later with negotiations we have been able to sign this particular deal. Now it is the time to implement. All the other countries will have to come together, find out the details of the deal, figure out the details and start implementing these particular deals, or let's say the Pillar 1 as well as Pillar 2 in the respective countries. Now this is an update. What is an update here? India, along with many other countries, are hesitant to come up and say that we will not be, in the future, we will not be introducing any type of a tax regarding digital services. I'll repeat the statement. Some of the countries within the G24 grouping, including India, they are basically saying we will not give any kind of, let's say, guarantee that in the future we will not be introducing any type of digital services tax. Because understand the logic here. There are many of these particular digital companies on which we have already implemented the taxes. In case of India, the best example is equalization levy. The deal that we are referring to here, GMCT, Global Minimum Corporate Tax Deal, under that there is a pillar 1 and pillar 2. And if you want to implement these particular pillars, the member countries are asked to give a guarantee that in the future they are not going to do, but India is hesitant. Along with India, there are many other countries. What is the reason? The reason is very simple here. These countries have two arguments. First argument is USA so far has not given any kind of indication that they are in favor of pillar 1, and they have not even signed the pillar 2 of the deal. Okay, right? They have not given any indication. That is one concern. Second concern is that these member countries, including India, are now arguing that whether to impose or not to impose the tax, it is their sovereign right. I hope you understand this. Whether to impose or not to impose in the future any type of these particular taxes, it is their sovereign right. How can they basically give away a sovereign right under the concept of this particular deal? And that is the precise reason various experts have already stated that the timeline to implement this particular deal was already very ambitious, because you're talking about more than 130 countries which have to come together, negotiate and implement this particular deal. Now further, with India along with many other countries raising this particular issue, this deal will be further delayed. So this is an update regarding global tax deal. Now some of you might be thinking, sir, what about pillar 1 as well as pillar 2? Very simple. Pillar 2 discusses a minimum corporate tax rate of 15%. Have you understand this? Pillar 2 discusses a minimum corporate tax rate of 15%. And the pillar 1 discusses that some of the profits from these multinational enterprises, beyond certain limits, the profits would be taken and distributed amongst those particular countries from which the sales have been generated. I will repeat the statement here. Pillar 1 basically denotes that, or it signifies that part of the profits of these multinational enterprises would be taken, given to the countries from where they are generating revenues. That is, which countries are mainly the markets for these particular companies. They will be getting part of the profits. And second pillar is 15% minimum corporate tax. That is, in simple terms, imagine a company is originated in one country, home country is first country 1, and it is paying taxes in some other country. That is, on the corporate profits, it is paying taxes somewhere else. As per this pillar 2, in the second country where they are paying the taxes, if the corporate tax rate is less than 15%, then the home country where the company originated will have the right to impose additional corporate taxes, impose a higher corporate taxes and collect this particular revenue, right? That is the concept of pillar 2. So these are the two very important pillars in the concept or under the context of global tax deal. Let me go to the next article. The cabinet has approved enhancing ECLGS corpus by 50,000 crore rupees. First and foremost, what is this ECLGS? Emergency Credit Line Guarantee Scheme. Couple of years ago, when the pandemic was actually ravaging the whole economy, Government of India announced a package by the name of Atmanirbhar Bharat. A and B, Atmanirbhar Bharat package. And under many of the initiatives that the government introduced under Atmanirbhar Bharat, one of the very important initiatives was Emergency Credit Line Guarantee Scheme, ECLGS. It was introduced with around 3 lakh crore rupee corpus. Later it has been extended, the application period, that is the time period for the scheme also has been extended. Now very recently, the cabinet has approved that ECLGS will be, or the corpus will be extended by another 50,000 crore rupees taking the total corpus to 5 lakh crore rupees. Taking the total amount of the corpus under the ECLGS to 5 lakh crore or 5 trillion rupees. Either ways, it is correct, one and the same. Now, what is this concept of ECLGS and why extension has been provided? Let's answer both the questions. That will be more than sufficient for UPSC exams. Imagine here is a company. This company has suffered because of the pandemic, and even now it is suffering because of the aftermath of the pandemic. It has taken loan from a bank and it is unable to repay the loan. Now, after a certain number of days, the loan will be classified as a non-performing asset. Action will be taken by the bank against the company, etc. You know the drill. But Government of India has identified, yes, there is a stress in specific sectors because of this. During pandemic, the stress was observed. Even though we are over or we have crossed the stages of the pandemic, even today, there are certain sectors which are getting affected because the demand is yet to pick up to the pre-pandemic level. The example that has been quoted here, for which the extension has been provided, is the hospitality sector. The hospitality sector is experiencing the aftermath of the pandemic. The demand is subdued. Demand has not reached to the pre-pandemic level, and as a result of this, the companies which are there or the units which are there in the hospitality sector even today are suffering because of this. The government, in order to provide support to these particular units, introduced the concept of emergency credit line guarantee scheme. Under the ECLGS, whenever a bank will provide a loan to such companies, the loans are guaranteed. I will repeat the statement here. Whenever the loans are provided by the banks to such companies which are there in the sectors identified under ECLGS, under the ECLGS, the guarantees will be provided to such loans. Which means, if the company is unable to repay the dues, then the funds will be taken from the ECLGS provided to the bank. That is the concept of emergency credit line guarantee scheme. So for more than 3 lakh crore worth of loans have been issued, the data is given, you don't need to mug up. 3.67 trillion rupees worth of loans have been sanctioned under the ECLGS scheme till 5th of August 2022. And the expectation is that because this particular sector, that is hospitality sector, is under stress, the units under the hospitality sector will be able to take loans without being worried about the guarantees for it and recover from the aftermath of the pandemic. That is the argument related to the extension of ECLGS here. Next article regarding farm loan subsidy. The central government has restored farm loan interest subsidy as rates rises. What do you mean by this? Let's understand. Here is a farmer. This farmer will go to a bank, apply for a loan, take a loan. And when the bank has given a loan, obviously the bank has to charge rate of interest. ROI means rate of interest. And this farmer will pay the rate of interest, whatever it is. We'll come to the exact numbers in a couple of minutes. Just wait for it. Whatever the rate of interest, the farmer has to pay this particular rate of interest to the bank. Now, Government of India, many years ago, felt that the farmer should be able to get access to institutional credit at affordable rate of interest. That is, the rate of interest on the loans which are given to the farmers by the banking sector should not be high, should be at an affordable level. And that's a precise reason why Government of India announced the concept of farm loan interest subsidy. That is, interest subvention scheme was announced by the government. Under the interest subvention scheme, the logic is very simple. The bank will be asked to provide the loans to the farmers, not all the loans, specifically short-term loans up to 3 lakh rupees. Remember this, short-term loans up to 3 lakh rupees would be covered here. Now, the bank would be providing the loan, short-term loan by the way, up to 3 lakh rupees to the farmer, and the government of India would simply say, fix the rate of interest at 7%. Fix the rate of interest at 7%. Let the farmer pay a rate of interest of 7% on the loans that they have taken from you. But some of the banks will simply say, sir, the actual rate of interest that I'm supposed to charge is more than 7%. It is, let's say, 8%, it is 9%, etc. In that particular situation, the government will simply say, you fix at 7%, your actual rate of interest is 9%. The 2% I will provide it in the form of interest subvention. I will give that particular 2% to the bank itself, so that rather than charging 9% to the farmer, the bank will be charging only 7% rate of interest. This is the first point. Second very important point. In the last couple of years, the rate of interest have been reduced by RBI. That is, RBI has reduced the lending rates, and because RBI has reduced the lending rates, what has happened to the lending rate by the banks? The banks also have reduced the lending rate. Earlier also we have discussed this. And that is the precise reason why Government of India had withdrawn the concept of interest subvention scheme in 2020. In fact, the previous Chief Minister of Maharashtra had written a letter to the central government asking for the continuation of this interest subvention scheme. Now Government of India says that because RBI is increasing the interest rate, that is the policy rates have been increased and they will keep on increasing in order to control inflation now, the banks will also have to increase the rate of interest on such loans that they are giving to farmer. That will become a burden for the farmer, because earlier the interest rates were lower, policy rate was lower, banks were able to manage and give loans at 7% to the farmers. But because the repo rate is increasing, now the banks do not have any option but to increase the lending rate on the loans that they are giving to farmers. In order to provide that earlier cushion that they gave to the farmer, government has reintroduced the interest subvention scheme again from 2022-23 to 24 and 25. And the article simply says, in order to provide this particular interest subvention of 1.5% for all the financial institutions. Remember, this can also be asked by UPSC. Interest subvention scheme covers all the financial institutions, including cooperative banks. Sir, what kind of financial institutions are you talking of? Public sector banks, private sector banks, small finance banks, regional rural banks, cooperative banks, and primary agriculture cooperatives. All these financial institutions are covered under the interest subvention scheme. So 1.5% of interest subvention has been announced by the government, and for this government says we are going to incur an additional cost of more than 34,000 crore rupees, 34,856 crore rupees worth of interest subsidy will be provided here. So this is the information regarding interest subvention scheme that has been reintroduced by the government. But before going forward, I want to add one more point here. In addition to this interest subvention, remember this, prompt repayment incentive is also there here. PRI, prompt repayment incentive. That is, here is a farmer who has taken loan from a bank. He is promptly repaying the loan to the bank. He has repaid the loan. Then the government says, you have paid a rate of interest of 7% to the bank. Because you have promptly repaid the loan, I will give you an incentive of 3%. I will give you interest of 3% back. And as a result of this, the effective rate of interest that this farmer will end up paying, effective rate of interest, will be 4%. So these are some of the very important points regarding farm loan subsidy. Now based on this, consider the following statements regarding interest subvention scheme. If the farmer makes a prompt repayment, then the effective interest rates applicable on all the loans, underline the term, all the loans taken by the farmer will be 4%. Wrong. This statement is wrong. The interest subvention scheme doesn't cover all the loans. It covers short-term loans up to 3 lakh rupees. Simple. So will the farmer get interest subvention on all the loans? Absolutely no. the interest subvention is applicable on short-term loans up to 3 lakh rupees. Statement 2 is correct. Right option for the question will be option B, only 2. Let me go to the next article regarding urea prices. We'll not be discussing how government decides urea prices because urea was so much in the current affairs. In the earlier videos, we have already discussed that. Just an update here. We have already discussed that Government of India fixes MRP for the urea. There are different types of fertilizers. DAP is there, MOP is there, urea is there. In case of urea, Government of India fixes MRP. What is the MRP currently for the bag of urea? If a bag of urea weighing, let's say, 50 kgs, then the Government of India has decided MRP of 268 rupees. And if the bag of urea weighs 45 kgs, then the Government of India has fixed an MRP of 242 rupees. However, please remember this. If it is a neem coated urea, above and beyond the MRP, charges will be added. Have you understand this? So this is the pricing that has been fixed by the government, MRP for the urea. Why? Government of India has the statutory right or statutorily fixes the MRP for urea. The last time the MRP was revised for urea was back in April 2010. The data is given. Straightforward data is given. So back in April 2010, Government of India revised the MRP. And after that, Government of India has not revised the MRP for urea. Now understand the problem here. The manufacturing cost for urea has kept on increasing, especially in the last 1.5 years, because the cost of natural gas has increased. Cost of raw materials or ingredients has increased. The manufacturing cost has increased. And if the manufacturing cost is X rupees and Government of India has decided MRP of Y rupees, assuming X is greater than Y, which is generally the case. When X is greater than Y, Government of India will pay this difference in the form of subsidy to manufacturers of urea. In India, there are more than 30 manufacturers. In fact, to be very precise, 32 manufacturers are there. And most of them, 30 of them, are using the natural gas as a raw material to produce urea and sell it. And because the cost of natural gas has increased, the cost of production of urea also has increased. But because Government of India decides the MRP, the difference between both, that is the actual cost of production and the MRP, also has increased, which means the subsidy outgo or the subsidy paid by the government for urea has increased. As such, for the current financial year, Government of India has fixed a total amount of more than 1 lakh crore rupees, that is 1,05,000 crore rupees worth of subsidy for overall all the fertilizers. But it should not be surprising to understand that majority of this particular fertilizer subsidy is incurred because of urea itself. So more than 60,000 crore rupees, that is to be very precise 63,000 crore rupees worth of subsidy has been allocated by the government for urea for the current financial year. But because the cost of production has increased, the subsidy that is paid by the government has increased. Out of this, around 39% of the subsidy has already been spent by the government in the first quarter itself. In the last 3 months, Government of India has already spent 39%. So now the concern is, if the MRP is not revised, then the amount of subsidy that is there with the government will not be sufficient. And that is the precise reason there was a discussion whether the government will revise the MRP for urea. And Government of India has clearly stated, no, we will not be revising the MRP. Remember this, Government of India has clearly stated, we are not going to revise the MRP. And now the concern is that the subsidy will overshoot. The urea subsidy as well as the overall fertilizer subsidy will be more than the allocation that is done by the government. So this is the list of, or that is the very important points which have been provided in the article regarding urea prices. The next article regarding UPI in United Kingdom. Now before I start the article, let me ask a very simple question. Apart from India and of course, right, the United Kingdom, in which other countries do you think you as a traveler, if you have gone there for tourism, for studies, whatever it is, you are allowed to use UPI for making payments. I'll repeat the question so that it is clear to you. Apart from India, because anyways, right, in India we are using UPI for making transactions or making payments on day-to-day basis. Day in and day out, we have been using UPI to make transactions. But where, apart from India, where or which are the other countries do you think where we can use UPI to make transactions? Why am I asking this kind of a question? Next year, the same kind of question can be asked by UPSC in the prelims. Now, coming to the current affairs point here, the NPCI, right, or the international arm of NPCI, NPCI International Payments Limited, NIPL, has announced that now an Indian who is traveling to United Kingdom can use UPI to make transactions or to make payments even in the United Kingdom. Right now, only QR code based payments will be introduced, and over a period of time, it shall be extended. That is an update which has been provided here. More than this, nothing else is important. Don't worry about, right, the technology are using, etc., from this particular article point of view. Now, the last article for the day, just an update for you people, because already in the last couple of months, we have been discussing this regarding inflation target. If you see this particular graph, don't mug up the graph, just observe the graph. What is the common denominator that you will find? Right? Don't say that, sir, it is a graph for CPI. That's a common denominator. It's a graph for CPI. What is the common thing that you need to find here or observe is very simple. From the month of January, the inflation rate for all the months starting from January has been more than 6%. And under the concept of inflation targeting, I hope you remember this. The target that has been given by the government of India to RBI to maintain inflation is 4% plus or minus 2% or 200 basis points, which is nothing but 2%. Which means RBI is allowed to maintain inflation at lowest level of 2% or highest level at 6%. Now, what will happen if the inflation is more than 6%? Obviously, RBI has to take measures in order to control inflation. But one of the provisions of Monetary Policy Framework Agreement, MPFA, says that whenever inflation remains below the threshold level or above the threshold level for 3 consecutive quarters, then the Reserve Bank of India has to give a written reply to Government of India. Now, whether to make the report public or not, it is entirely left to the Finance Minister or specifically the Government of India. But because the inflation has consistently been above 6%, if you see these particular numbers, you will realize it has consistently remained more than 6% for the January to April quarter or January to March, then April to June, then till September, because we are not yet in the September. The report will be published, don't worry. And as per RBI estimates itself, inflation will still remain more than 6% even for the current quarter also. So now the concern is that because for 3 consecutive quarters, inflation has remained more than 6%, RBI has to give a written reply to Government of India. And that is what is conveyed in this particular article. RBI committee will be meeting to draft or to basically prepare a report which they will submit to Government of India. After the current quarter, right? After the current quarter, they will be submitting a report saying that these are the reasons why inflation rate has remained above the threshold level. These are the measures which we will take to reduce or bring the inflation under the control. And within this particular time period, we'll be able to bring it under control. These details will be given by the Reserve Bank of India to Ministry of Finance in this report. This is the gist of the article provided here. So these are the various articles as well as the questions related to these articles which were published in different newspapers between 13th to 19th August 2022. If you like the initiative, hit the like button, provide your valuable comments in the section below, and if you have not yet subscribed to Byjus Exam Prep IAS, kindly do it now. Thank you. Have a great day.